the way that the commodity exposure is constructed is very important, right? So there's two types of sort of commodity products: those that are futures based and those that are based on the actual underlying commodity, where things like gold or silver or some of the industrial metals will fit in, whereas some of the soft commodities that are future based, like corn or like oil, would sort of fit in there. The problem with the futures side of it, where you have to keep on rolling over these contracts, is you have this situation known as contango, right? Meaning that you have to keep on rolling over these futures contracts, and time is against you, which means you're never going to exactly replicate the actual current spot price of those commodities. So you can ameliorate that a bit by just looking for those commodity plays that are more in that sort of 2 to 3 month rollover time frame. Buy yourself a little bit of time in the way the structure is. But it is important, right? Because not all commodity products are created equally, right? And I think, as my colleague Dan Weisskopf likes to say, structure matters when it comes to looking at commodity products. There is a lot of value, I think, in a lot of the soft commodities which have gone vertical. There's a lot of value, I think, in the metals and the industrials, again, like copper. But I think you have to kind of just mix it properly. Oil is a little bit trickier, I think, in some ways, because oil is so directly tied to inflation expectations that really a play on oil is a play on bonds. I mean, it's almost one for one in terms of that relationship of oil prices to inflation expectations. So again, I think a mix. I think just be mindful of that contango, part of a commodity investment, and just sizing properly is the key to everything.